and welcome to the latest episode of our Institutional Insights podcast series from Legal & General. I am Sabeen Iftikhar, Director in our Pension Risk Transfer business, and it is my pleasure to be hosting this episode. I'm joined by Aysha Patel, New Business Origination Lead in Pension Risk Transfer, and Mat Webb, Head of Insurer Solutions and Strategy at LGIM. Aysha and Mat will be talking about how pension schemes can take advantage of market volatility and capture favourable pricing opportunities. Aysha and Mat recently presented at the Professional Pensions Endgame Summit about this topic, and we're going to use some slides from the event to support the discussion, along with a few case studies. So, Aysha, to kick us off, can you talk us through why insurer pricing varies with market conditions?
Yeah, sure, Sabine. Thanks. I've got a couple of slides that can help illustrate this point. But firstly, we need to look at how an insurer invests to understand the factors that will affect their underlying pricing. So insurers operate under a regime called Solvency II, which means they have to invest in a predefined way to ensure that they can meet the pension promises that they take on. So given the long-term nature of the liabilities, these pension promises, we need to hold assets that as closely as possible match the cash flow profiles that we need to pay out. And this really incentivizes us to invest in things like gilts, credit, and then high quality or liquid investments, which we call direct investments, and to meet these pension promises. This is illustrated on the slide that's up on the screen, on the chart on the right-hand side. So you've got the red line, which represents the cash flow payment profile that we're expecting to make. And then you've got the bar charts, which are split up between the different assets that we hold. And that shows the profile of the asset payments. On the left-hand side, there is a donut chart, which shows how the asset profile breaks down between the different asset categories. So split between gilts, credit, and the direct investments. It's probably worth noting that different insurers, although we invest in the same underlying asset classes, we can invest a different proportion in those asset classes, which means that market conditions will affect our pricing in slightly different ways. If I move to the second chart, this shows how buying pricing for a typical pensioner portfolio has changed over the period since December 2019. It shows how the implied return on the buy-in relative to a portfolio of gilts. 2 points probably to note from this chart. The first is that pricing is very volatile over that period, and that's really driven by the changes in credit spreads, interest rates, and inflation, which affect the underlying assets and liabilities. And the second point is really around the volatility that you can see in various times in that market. So in spring 2020, you can see a very material improvement, which is the spike in the chart, where insurer pricing improved significantly. And that was really due to the widening of credit spreads and the increased volatility at that time. And as mentioned before, because of the way that insurers invest, that's driven by the significant proportion of credit in the underlying portfolio. So really, just to summarize, insurer pricing does vary with market conditions, and that's driven by the underlying assets in which an insurer invests to meet the pension promises that they're going to make.
Brilliant. Thanks, Aysha. That's really helpful. And I guess turning to you, Mat, what does this volatility that Aysha talked about mean for pension schemes and their investment portfolios?
So I think the important factor is that there's a difference between what the insurers are doing and generally what pension schemes are doing. And this is illustrated on the next slide with a series of example donuts of investment strategies. Now, we've already heard from Aysha that the different insurers invest in slightly different ratios of the different components of LDI, credit, and direct investments, and that also that those ratios will change over time depending on market conditions to generate the most attractive price. So the impact, therefore, on buyout funding volatility for a pension scheme will depend largely on the assets they're holding and how different those assets are compared to the insurer investment strategy. So on the chart, we show three illustrations, one being a late phase growth pension scheme that's heading towards endgame and still has a relatively high investment target, a relatively high allocation to equity, but still diversified into credit with a relatively high hedge ratio. The second is a credit self-sufficiency portfolio, which is reaching their own endgame of seeking runoff over time. And they're invested a lot like an insurer, in fact, investing in similar assets such as credit and LDI, but with a lower or zero allocation to equity. And then right at the end, a low dependency portfolio being an illustration of what the pensions regulator is illustrating for pension schemes as they approach an endgame, thinking of something that is predominantly interest rate hedged, but with a low allocation necessary to to market investments. Now, we can see that from these three different portfolios, the buyout funding level volatility of these three schemes will be quite different. The first one has equities and is slightly underweight credit. The second one has no equities and is very highly weighted to credit. And the third one has a relatively modest allocation to the two. And what that means is that the funding level volatility for these three schemes will run around quite widely. Now, to understand the impact of this further, we put a model together, and that's shown on the slide, the following slide, where we've illustrated through an ALM projection the potential for various different buyout funding level projections over time for a pension scheme based on its asset allocation. And importantly, and then crucially for this model, also the asset allocation of the insurer. So what these charts are showing is the likely funding level over time for, in this case, 50 different runs of that potential stochastic process, taking into account both the volatility of the assets and the volatility of the liabilities inside the buyout funding level. And so what we can see is a range of outcomes. And we can see volatility quite clearly on this chart, that the funding level is moving around quite significantly. And it brings us to two quite important conclusions. So the first one is that for those pension schemes that are almost there at their end game of buyout, let's say a few years away, the single fact of having that volatility can be the most important factor to drive whether or not you can achieve buyout. And that's a much larger impact than just the necessary outperformance of the assets over time by relation to the buyout funding level. The second conclusion, though, is that the ability to capture that buyout process, to be able to get to 100, and in this chart, the green dot hit 100 and execute, if it's something you can monitor frequently, can add significant value to you. So the chart on the left-hand side is showing the number of buyouts that have been achieved, looking at monthly observations, whereas the chart on the right is showing annual observations. And not unsurprisingly, the ability to be successful is much greater on the left-hand side when we're monitoring more frequently. In fact, in this case, almost 20% more successful in terms of the average time to buy out for the scheme. The key question is how to do that. I'll pass that back to you, Sabeen.
Great, thanks, Matt. And Aysha, I know we've seen various examples where we work together with pension schemes to sort of help them do that monitoring. Could you talk us through maybe an example of where this has been done successfully recently?
Sure, that's no problem. One of the case studies that we presented at the seminar was the £650 million full scheme transaction we did with the Mitchells and Butlers Executive Pension Plan. And this was a great transaction showing the benefits of this monitoring approach. It was 2 years of preparation for the scheme and a collaborative price monitoring approach with insurers that ultimately meant the scheme was able to transact at a level that was below their price target. So just to give a bit of background before I touch on the various bits of the slide. So the trustees approached the market back in late 2019, looking to select two insurers with which to implement a price monitoring approach. They did something different to a usual transaction, which was they didn't ask for pricing up front, but instead judged insurers on other credentials. So, their experience in the market, their administration capabilities, their financial security, and their ESG credentials, as well as their ability to accommodate the price monitoring approach and also key contractual and commercial terms. So you can see from the chart, there were two further improvements in our pricing relative to the trustees' target that we were able to pass on before the decision-making meeting. One is from the actual reinsurance pricing we received, which was much better than what we'd estimated, and that's the red oval on the chart. And the other is from monitoring our pricing against the premium payment portfolio, which is the yellow oval, the last yellow oval on the chart. We were able to pass these on ahead of the trustees' decision-making meeting, and this gave the trustees a buffer versus the pricing in case it started to move away from them as they were making their decisions. The trustees agreed to proceed with us, which is great, and we entered in exclusivity shortly afterwards. So this was ultimately a great outcome for the trustees, where they benefited from a collaborative price monitoring approach, and it meant they were ultimately able to secure a transaction at below their price target. So if we fast forward now to June 2021, you can see there was a material change in our pricing versus the trustees' target. That's highlighted by the yellow oval you can see on the chart. And that was us reviewing the asset strategy and adjusting it such that it contained new illiquid assets that better match the underlying liabilities, and were able to therefore improve our price relative to the trustees' target. You can see that kind of brought us within touching distance of the trustees' target. And so what we did at that point was start to monitor more closely how pricing was moving. We also did two other things at that point in time. The first was to reach out to the insurance market and obtain actual reinsurance pricing. And up until this point, we'd been using estimated reinsurance pricing. And now that we had a greater sort of transaction certainty, we were able to get good engagement from the reinsurance market. The other thing we did was we stopped just monitoring pricing in isolation. We started to look at it against the assets that trustee was going to use to pay the premium. You can see in September 2021, the market volatility brought us to the trustees' target. So we submitted a price update to the trustees for consideration at a meeting a couple of weeks later. In the meantime, we got actual reinsurance pricing through, and we were able to pass that directly through to the price that we submitted to the trustees. And you can see that gave us an improvement relative to the target shown by the red oval on the chart. We also had another further improvement that we were able to pass through before the trustees' decision-making meeting, and that was how relative to how the assets had moved in the premium payment portfolio. So at the trustees' meeting, they had a price below the target that gave them a buffer just in case pricing started to move away from them as they were making their decisions. At the trustee meeting, we were lucky to be chosen as the selected insurer, and then we entered into a period of exclusivity where we locked our premium to their premium payment portfolio so that we minimised any out-of-market risks, such that the price would move exactly like the assets, and therefore the trustees would see their pricing moving in the same way before they transacted.
Great, Aysha, and that seems like an excellent example of how this has worked in practice and ended up actually transacting below the trustees' target. Matt, just a question to you. I mean, that sounds like an interesting approach for pension schemes that are sort of ready and you know they've considered all the steps they need to take. But what if a pension scheme's not quite there? What could they do if they're sort of at a much earlier stage of their de-risking journey?
Thank you. So that's an important question for schemes that are further away, who also want to try and capture the benefit of good market pricing in the buyout market. And they can do that through thinking about doing a series of phased buy-ins over time, where each one is ideally timed at a time when pricing is particularly attractive. Now, on the slide that we've showed for this, we have an illustration of how this can be achieved through using a traditional de-risking framework. Now, this is a common approach amongst pension scheme trustees to de-risk based on a funding level, such that the closer they get to their ultimate goal with a higher funding level, they can afford to de-risk and move assets into a more de-risk strategy. And the only difference here is that we're calibrating this to the overall buyout funding level in the longer term. So that means that in a situation where the assets have performed particularly well, or in a position where the buyout pricing is particularly attractive at a point in time, the funding level is higher and it can therefore afford to de-risk towards that goal. On the right-hand side, we then set out a series of different investment portfolios which would reflect each trigger strategy, moving to a more de-risked approach closer to the buyout target. Now, this can be done within the investment arena through moving towards a strategy that has a higher hedge ratio, a higher allocation to credit, but it can also be achieved through executing a series of buy-ins, which captures the absolute value of the good attractive pricing at a point in time.
And Aysha, I know at the beginning you talked about that sort of spike in spreads in March in 2020. So just linking that to what Matt said, have we seen this approach work in practice when the spreads sort of widened?
Thanks, Sabeen. Yeah, a great example of that is the ICI pension fund. So to give a little bit of background before I talk to the chart, the ICI pension fund came to the market back in 2014 for its first pensioner buy-in. And at that point, it was already a very mature pension scheme, so around 10 billion of liability. Since then, and just before the transaction I'm about to talk about, it had done 8 buy-ins, covering around about 9 billion of its liabilities. So the chart zooms in on that period that we were talking about, that chart we were talking to earlier, zooms in on the period over the beginning of 2020. So again, it shows the pensioner pricing for a typical pensioner buy-in over that period. We saw credit spreads significantly widen at that point in time. There was increased volatility in the market, and that created favourable pricing opportunities for pension schemes. And by this stage, the ICI Pension Fund was in a regular process of annually insuring new retirees, as they had already insured all of their current retiree population. And they were doing that generally in the autumn of each year. It was really tried and tested framework that they had in place. So on seeing the opportunity arrive in the market, we reached out to the ICI Pension Fund to make them aware of the potential favourable pricing opportunity that was available. For them, it was really a decision around, do we do a larger transaction in the autumn, or do we do a smaller transaction now, taking advantage of that pricing? And they decided to proceed rather than wait and then risk obviously pricing and moving away from them as they reach the autumn. So you can see on the chart the period of which we first raised the opportunity, and then the period in which the decision was made. That's about a 5 to 6 week period. And really that was because the trustees needed to give us revised cut of data. And there was also an additional governance step in the process, given it was an out of cycle situation rather than being the usual autumn process. We were able to deliver pricing to them, and then within a period of 10 working days, we were able to agree a £70 million transaction with them. And that's really because they have in place this pre-agreed framework around the legal documentation and a very nimble governance process.
And how long does it typically take to put these types of arrangements that we've talked about in place for pension schemes?
So I think you start with the first process, which will take the usual sort of time period of, say, 3 to 4 months in order to go from selecting an insurer to setting up the framework for them to give you regular pricing. And then once they have a regular pricing process in place, as long as we have the data available, we can turn around pricing very quickly within the space of a couple of weeks, say. And then again, if you have the pre-existing documentation in place, then you're able to sign that in a matter of business days.
Matt, a broader question to finish. What would be a good investment portfolio for pension schemes looking to capture these market opportunities that we've talked about? And what are your top tips for schemes that are approaching their end game?
Well, the key thing to point out is that there is a recognition of this volatility between the asset strategy of the pension scheme and the asset strategy of the insurer. So, for example, if you were to invest in a portfolio that's very credit heavy, very hedged, very much a self-sufficiency portfolio, one might expect that the route to buyout there would be slow and steady. But investing in something that's not that, something that's not the investor portfolio of the insurance company, something with equities inside of it, gives you an opportunity. But it only gives you an opportunity if you can catch it, which means that you have to have the governance in place to be able to monitor the buy-in or buyout price and to be able to execute quickly. What I can certainly guarantee is that if you're not ready, you can't capture it. But if you are ready, then there is a very strong opportunity that being able to look at this and think about how to align the portfolio towards the insurance company progressively when pricing is attractive can be very valuable indeed.
Aysha and Matt, thank you very much for joining me today, and I hope our listeners found this as insightful as I did. I think the key takeaway for me is no matter where pension schemes are in their de-risking journey, there are things we can do to help them to try and capture these opportunities in the market. Don't forget, you can subscribe to our Institutional Insights podcast via Apple Podcast and Spotify so you don't miss an episode. Thanks for listening.